Right. I welcome you all, ladies and gentlemen, to this short presentation where we are going to, go through this past exam question Vyxyn Co. All right, and this one is related to investment appraiser, and I think it is going to help us understand everything we have just covered in our week 4 lecture series. Okay, it has been a very long week. I understand that. Yes, I understand that. But you guys, you just need to watch this video again until, to the end of it. All right. Vyxyn Co is evaluating a planned investment in a new product costing 20 million, payable at the start of the first year of operation. The product will be produced for 4 years, at the end of which, so we are told that the project is for 4 years, at the end of which production will cease. Thus, the investment project will have a terminal value of 0. Financial information relating to the investment project is as follows. So there is year 1, year 2, year 3, year 4. The sales volume in units per year, that's 440,000 in year 1, 550,000 year 2, 720 year 3, 400,000 year 4. The selling price per unit is as given, and then fixed cost per year, that's as given as well. These selling prices have not yet been adjusted for selling price inflation, which is expected to be 3.5% per year. The annual fixed costs are given above in nominal terms. All right. Variable cost per unit depends on whether competition is maintained between suppliers of key components. The purchasing department has made the following forecast: competition, strong, moderate, weak. Probability: if the competition is strong, then the probability is 45% that the competition will be strong, 35% that it will be moderate, 20% that it will be weak. Variable cost per unit $10.80 when the competition is strong, $12 when the competition is moderate, and $14.70 when the competition is weak. The variable costs in these forecasts are before taking account of variable cost inflation of 4% per year. Vyxyn Co can claim tax allowable depreciation on a 25% per year reducing balance basis on the full investment cost of 20 million and pays corporation tax of 28% per year, 1 year in arrears. It is planned to finance the investment project with an issue of 8% loan notes redeemable in 10 years' time. Vyxyn Co has a nominal after-tax weighted average cost of capital of 10%, a real after-tax weighted average cost of capital of 7%, and a cost of equity of 11%. All right, we haven't covered the cost of capital topic, but you mustn't panic because this one is just straightforward. Now, the first question, remember, there was the other portion which we omitted here because it requires wide coverage of the syllabus, and for now we just needed these 2 questions to answer so that we round everything up. Now, the first requirement is that discuss the difference between risk and uncertainty in relation to investment appraisal. All right. And this one, ladies and gentlemen, is very simple because we discussed in the video, our immediate last video. Okay. We talked about, when we were talking about sensitivity analysis, we talked about risk and uncertainty, where we say that the 2 words can be used interchangeably. However, they are very, very different. Okay. When we are talking of risk, we are referring to a situation where an investment project has several possible outcomes, okay? It has several possible outcomes, all of which are known, okay? So risk is known. When you are talking of risk, it is known, all right? From history, or past experience Okay, when we are talking of risk, we are referring to a situation where the investment has several outcomes. All right, several outcomes. All right, has several outcomes, all of which are known and to which probabilities can be attached. Probability can be attached. For example, on the basis of past experience, okay, on the basis of past experience, we can attach probability that the competition could be weak. There is a probability of 10% that the competition could be weak in summer, and then in winter the probability of competition, that the competition will be strong is 85%. Okay, so that's how, because we know this from our previous experience. But now this simply means that risk can be quantified. It can be quantified. All right, and measured by the variability of returns of an investment project. All right, so when you're talking of risk, we are simply referring to a situation which can be supported by numbers. All right, it can be supported by numbers. Now, when you're talking of uncertainty, all right, uncertainty, uncertainty. Okay, this refers to a situation, all right, where an investment project has several possible outcomes, but it is not possible to assign probability to their occurrence. Okay, you can't assign any probability because it is a situation which is quite uncertain. All right, we do not have some past experience of the issue. All right, but there is a probability. There is a possibility that the project can fail or can be successful, but we are not quite sure by tangible probabilities whether it is going to fail or to succeed. All right, so it is therefore not possible to say which outcome would really occur. In the case of uncertainty. So what is the overall difference? The overall difference, ladies and gentlemen, the overall difference here is that the overall difference between risk and uncertainty, therefore, is that risk can be quantified, whereas uncertainty cannot be quantified. Risk, in other words, increases with the variability of returns, whereas uncertainty increases with the project life. The longer the period at which the project will be undertaken, the higher the uncertainty attached. Okay, so the longer the period, the higher the uncertainty or the increase of the uncertainty. All right. Yes, that could be, those could be the arguments which you can use to answer part A. All right. But I hope you have been helped and you understand what is going on. All right. Because when you're talking of the quantification of risk, this is the allocation of probabilities. We can be quite sure. We can be, in the risk situation, we are quite informed of what is going on from our past experience. Okay, but when you are talking of uncertainty, we are not quite sure because we haven't experienced such a thing, so we are not sure. All right. Now let us do the part B, which has got 9 marks. Okay, calculate the expected net present value of the investment project and comment on its financial acceptability on the risk relating to variable cost. All right, calculate the expected net present value of the investment and comment on its financial acceptability and on the risk relating to variable cost. Okay, so ladies and gentlemen, this question can be downloaded. Okay, the question can be downloaded on the link provided to the description of this video. So just download it if you want to refer to the question and you also want to flow with me as I do all the computations for you. All right. Let me try to open an Excel spreadsheet, okay, and see what will be going on. All right, so in the exam, you just have to make use of your spreadsheet apparatus and do your workings there. All right, so let me just pause a bit and continue on the spreadsheet. Okay, ladies and gentlemen, this is our spreadsheet and we don't have time to waste. Let us just ask the question and go home. Okay, so this is part B. You tell the examiner that this one is part B of the question and we want to calculate the NPV. So Npv calculation. All right, as usual, ladies and gentlemen, we start with our year. Okay, the year. All right, we have got year 1, year 2, year 3, year 4, and we move like that. Okay, we move like that. All right. So we've got year 0, year 1, year 2, year 3, year 4, year 5, right? And then we start with our sales revenue. Okay, the sales, all right? And you can leave space and do your workings. Okay, can do your workings can just come down here and do your workings. All right, you can have the portion for your workings. Now you can say working number 1 is for, all right, sales. Okay, sales revenue. Okay, your sales revenue is also going to be based on the year 1, year 2, year 3, year 4. Okay, now in the question we are given the selling price. Please download the question and refer to the question as I do the workings. By so doing, you won't be lost. Okay, the selling price per unit Okay, that is dollar per unit. This was given in year one. It was $26.50. All right, $26.50, and in year two it was $28.50 from the question. Year three it was $30. Year four, $26. All right, can just double click here to widen the cell. All right, and we need now to consider the inflation. We are told that the question was actually saying that the selling prices have not yet been adjusted for selling price inflation, which is expected to be 3.5% per year. The annual fixed, okay, that one is now for the. So let us inflate, okay, inflated by 3.5%. Okay, inflated at 3.5%. All right, per annum. Okay, so if we inflate this, it means that we are going to have for the first year there, which is equal to this amount, okay, multiplied by 1.035. Okay, that's 27.42. All right, and then we have got for the year two, it will be this figure multiplied by 1.035, but now it is to the power, sorry, to the power 2. Okay, so the selling price has become 30.52. Okay, we come here and say equal sign. All right, equal sign 30 multiplied by 1.035 to the power 3. We get that much. We move on to this last figure, which is equal to this figure multiplied by 1.035, okay, to the power 4. Okay, so those are our inflated selling prices. And then let's continue. Let's now involve the sales volume. The sales volume. Sales volume. The volume is in thousands of units. Thousands, okay? Units per year. Okay, and we are told that in the first year, they would produce 440,000, and then 550,000, and 720,000, and then rest at 400,000. Okay, so the sales income or revenue would be, this would be equal sign this value multiplied by this value. We get 12,068. Okay, we can drag and get everything we need. All right, So for the sales volume, ladies and gentlemen, we are done. We can try as well to burden up some little formatting could assist us as we proceed. Okay, and my machine is about to misbehave, as you can see here. Okay, so this is the figure, okay, which we need for the sales. My machine is started its behavior. It's okay. I hope to just respect me this time around. Okay, let me go the longer way. All right, so these are the figures we need, so we can just copy and paste them at the point which we need them in our NPV table. Okay, we want them to be here. Okay, what's going on? All right, this is to do with the formatting and the cell referencing issues. All right, so we can just paste them using this other function. Okay, that's there, we are done. Let's now worry about the variable cost. All right, so variable costs. The variable costs, ladies and gentlemen, are given in the question, and I think we just need to have a go at them with a working. So you come here and say working number 2, variable costs. Variable costs, and before we do our table for the years, we need to determine the variable costs, the expected variable costs, using the expected values technique, which we just cover in our the last video, last video, which we have just covered. Okay, that's where we explained the principle of expected values. Please refer to that video to understand more about expected value. So expected simply means average. Okay, expected or average or mean or mean. Okay, mean variable cost. Mean variable cost. So the expected or mean variable cost per unit. Okay, remember we are calculating per unit, so that if we know the unit value, then we are home and dry. Remember, we are given situations in the questions when this variable cost could be inferred. Okay, because we are told that variable cost per unit depends on whether competition is maintained between suppliers of key components. The purchasing department has made the following forecast, where they say that the variable cost per unit could be $10.80 if the competition is strong, and the probability that the competition will be strong is 45%. Okay, and then $12 per unit when the competition is moderate, but the probability that the competition will be moderate would be 35%, and so on. So we are going to determine our expected values using the techniques as already indicated. So we are going to say equal sign, okay, open brackets, equal sign, open brackets. The first amount which we need in our computation is for the first condition, okay, of the competition. All right, when the competition is strong, there is a probability of 45%. Okay, multiply by the unit cost, the variable cost per unit of $10.80, okay, $10.80. All right, so we close our bracket, all right, and then we say plus open brackets. When the competition is moderate, the probability is 35%, so 0.35, multiplied by the cost per unit of $12. We close our bracket and add open brackets points. The probability that the competition will be weak is 0.20. That's 20%, multiplied by the unit cost, variable cost per unit, $14.70. So we get the expected variable cost per unit is $12. Okay, so we can simply say these ones are in dollars per unit, so that examiners will see what we are doing. Okay, now let's move on to the computation of the variable cost, the total variable cost in each year. All right, so we come to our tables and start to open the year column. Year, right? Year 1, year 2, year 3, year 4. Okay, and variable cost per unit. Okay, that is dollar per unit. We've just calculated it as $12, so I simply have to just take our $12. Okay, remember there are no marks for showing that you are good at using Excel. Okay, if you try to show examiners that you are a good you're a quant when it comes to the use of Excel, that would be good and great for you, but make sure you won't delay yourself, okay, trying to come up with an out of this world Excel answer sheet. There is no time to play in the exam. All right, now the variable cost, we are going to use the average cost as given because this is based on the expected values. All right, and then we are told in the question that these variable costs are going to be inflated at 4% per annum. So inflated at 4% per annum. So we come here and say equal sign this amount multiplied by 1.04, get that amount, okay, and then we say equal sign 12. Okay, we can just type 12 or simply click there and multiply by 1.04 to the power 2 and get that amount. You come here, say equal sign, multiply by 1.04 to the power 3. Okay, also come here and say this amount multiplied by 1.04 to the power of 4. Okay, this one mustn't be bolded. Okay, we come here and say what are the sales volume. Okay, sales volume. Okay. The assumption here is that the all the goods produced are going to be equal to the goods that are sold. Okay, so the sales volume is also a representative of the production volume. Okay, because remember, normally in our management accounting or performance management costs, the variable costs are usually based on the production quantities. Okay, so this is the assumption which you could make. Also, you can point out that point on the discursive element where you have to make a comment in relation to variable costs, such that the assumption is known, or you let the examiners see that fact. Okay, and that would give you an edge, and because examiners expect you to show some maturity in the way you do your computations. You have to show them that you're understanding everything that is going on. Okay, so thousands units per year. Talking of thousands units per year. All right, so that's in year 1 we produced 440,000. In year 2 we produced 550,000. Year 3 720,000. Year 4 400,000. Okay, and then we come here and get the variable cost in total. Variable cost per year. We're talking of $1,000 per year. Okay, so we come here and say equal sign this amount multiplied by this amount. We get our 5,491, and then we drag everything. And those are our figures. Okay, we need these figures. We can as well bolden them up. All right, and we then have to talk of the tax allowable depreciation. Okay, before we take the figures to our main NPV table, we can finish all the computations. Okay, the capital allowances. Capital allowances. Capital allowances. Okay, we can have our year. All right, year 1. All right, we can have our costs. Okay, year 1. Okay, the cost of the assets was how much? The cost of the assets is 200,000. Let me see. No, it's 20 million, so that's 20,000. okay, 20,000. That's the cost of the asset, and we are told that this is going to be depreciated at 25%, reducing balance. So the capital allowance from our previous video at 25%. This is gonna be equal sign this much applied by 0.25. That's 5,000. Okay, and if we multiply this by, and I say it in the exam, no need to type that you are multiplying. You can just come here and say tax allowable depreciation, the third, no, sorry. Actually, the tax allowable depreciation is this much, okay? The capital allowance there we are referring there. That's the tax allowable depreciation. And my machine is okay. All right, Excel is reading that function as something that is igniting or as a link to it's almost like a link to an online page. Okay, let us just say tax allowable depreciation. Okay, tax allowable depreciation. What's going on? Okay, capital allowances. Capital allowances at 25%. All right. So this is the capital allowance at 25% is the same as the tax allowable depreciation. So here now we can say tax saving. Tax savings. So the tax savings is equal to this figure multiplied by the tax rate. And in our question, the tax rate is 28%. So that's 1,400. That's the tax allowable depreciation for the first year. All right. I mean the tax saving for the first year. Then we then get what is the new balance. The new balance here is going to be found by equal sign this amount, okay, minus this amount. We get 15,000, and we come to year 2. Year 2, we say capital allowance, okay, capital allowance at 25%, and that would be equal sign this much applied by 0.25, 25%. That's 3,750, okay, and this gives us a tax saving of equal sign this amount multiplied by 0.28%. That's 1050. Okay, then we move on to the next section. We say now, how much do we have in terms of the balance? Okay, the balance now is equal to this amount minus this amount, and we are at 11,250. So for year 3, the tax allowable depreciation would be equal sign this amount multiplied by 0.25. We get that amount. Okay, we then have to say this must give us a tax saving of this amount multiplied by 0.28%, which is the tax rate. Okay, now for the fourth year, we need to determine, okay, if we do not have a scrap value. Okay, so we come here and say scrap. The scrap value, in this case, we are told in the question that I'm trying to look for the scrap value. Okay. Okay. From the look of things, the scrap value is 0. Okay. The scrap value is 0 because we are told that the terminal value of the project will be 0. So which means there is a 0 scrap value. Okay. So there is need for us to establish what is called a balancing figure. Okay. By the end of the day, the capital allowances, the tax saving we are going to enjoy by the end of the day should equal to all these. Let me show you something. The total, okay, the total tax saving should be here, equal sign. This should be the cost of the investment was 20,000. Okay, 20,000. That was the total cost of the investment. So we need to enjoy the amount we need to enjoy should actually be 20,000 multiplied by 0.28%. We must enjoy a total of 5,600, okay, or 5,600,000. All right. So the capital allowance we need to enjoy in year 4 should be the balancing figure. Okay. Capital allowance in bracket balancing figure. The balancing figure here should be here. All right, which is equal to this figure minus this figure minus this figure minus this figure, and we must get our 2,362. Okay, that's the amount which should be recognized in the 4th year. Please rewind this video and see if you really want to pass. If you really want to pass this paper, please replay this video. Otherwise, there is going to be disaster. Now that we've done the major workings, let us get back to our main net present value table. All right, this is the main, and it should be held nice. Should be held nice. Okay. Now, the variable costs, let us copy them and paste. These are the variable costs, let us copy and paste them to our NPV table. So copy, paste. But these values should be in bracket. Okay, you can simply multiply them, make the figure by -1. Sorry. Multiply by what's going on? So always want an equal sign if you want. So if you don't want headaches, I didn't put the negative sign. You don't want headaches. Okay. Okay. Initially, during your computations, you can as well try to put the figures in their negative form just from the start to avoid the disappointments of these operations. Okay, but it's not a big deal. All right, so the figures are in negative form, so we can safely get our contribution. The contribution, because sales less variable cost, you will get your contribution, and this is equal to this amount minus this amount. And once you do that, just have to roll off, and you get your contribution. Okay. Sorry, there's been some double accounting. Okay, because if you say D cell D4, this is D4 minus, then there is you end up adding up things. So I'm sorry for that. So let us just say plus, because the number is already in negative. Okay, sorry for that. Okay, let's move. 65, 78. It's okay. Then once we get the contribution, let's talk of the fixed costs. The fixed cost per year. All right, the fixed cost per year, and these ones have to be also determined wisely. Okay, in as far as the fixed costs are concerned, you just have to stand on your principle. Okay, you are told by the examiner that the figures for the fixed costs are given in nominal terms. All right, so when we are talking of nominal terms, it means that inflation has already been included in the figures. Okay, so we just have to pick them as they are from the question. All right, so from the question, the fixed costs in year 1 are to be 1,100. So 1,100 negative. Then year 2, they are 1,121. Okay, negative again. And sorry. $1,121. and then year 3, that's 1155. Year 4, that's 1200. That's what happens. Then let's talk of other things. Okay, let's determine. These are now what we call taxable cash flows. They have to be, the difference here should be subjected to tax. So this is equal to, you can just use the sum function, sum this and that, you press enter and say, and drag everything out. Okay, we get that figure, those figures, and then we then have to put in our tax rate, tax at 28%. Let's impose our tax. Let's determine the tax component. Okay, but one thing for sure is that we need to determine when the tax is going to be paid. So if we go back to the question, we are told that the tax is paid 1 year in arrears. So all the operations or the cash flows for year 1 are going to be paid for in year 2. So we are going to say equal sign -1. Okay, -1 applied by -1 is just we want to make these cash flows negative. Okay, -1 multiplied by 0.28. Sorry, 0.28 multiplied by this figure. Okay, we get that amount. All right, we get that amount. Okay. Then we have to move on. We have to drag everything, and those are the figures which we have to content ourselves with. Okay, then we need to move on to the tax allowable depreciation benefits. Okay, tax allowable depreciation benefits, or tax benefit from tax allowable depreciation. So when I say third tax benefits, which we have just computed. Okay, and these also follow the same pattern. Okay, they will appear in the same columns with their former ordinary taxation from income. So we just pick them from our computations in working number 3. That is 1,400 to start with. Okay, negative. This one is not negative, it's just a positive. It's a positive income, 1,400. Okay, then we pick again 1050, 1050. You can as well pick the other figure there, that's 787.5, 787.5, and then lastly the big chunk. This was 2362.5, 2362.5. Okay, then we just have to add them up and get our after tax cash flows. Okay, or net cash flows rather. Okay, the after tax cash flows. Okay, but we have forgotten about one thing. Okay, we have forgotten about one thing here in year 0. We need to include our initial investment. This was 20,000 and it's a negative. Remember, all the cash flows here are in thousands. So you can simply write here and say thousand. So that the examiners will see that we are talking of thousands or millions here. Okay. Then you come here and say net cash flows or after tax cash flows. Let's rule off like this. Let's use this one. Make it nicer. Okay, so obviously here we are going to have this amount. Okay, here we are simply going to have this amount. Here this is equal sum okay. Let's try to drag it out. Okay. And here again you can simply say equal sign sum equal sign sum. Okay. Then discount factor at now. Here is the trick bit for the discount factor. Okay. In the question, we are told that it is planned to finance the investment project with an issue of 8% loan notes redeemable in 10 years' time. That one doesn't matter. Then Vyxyn Co has a nominal tax weighted average cost of capital of 10%. Then a real after tax weighted average cost of capital of 7% and a cost of equity of 11%. Now, here we are using cash flows which have been inflated. So if we are using inflated cash flows, then we are going to use the nominal after tax discount rate. So in this case, we are going to use the nominal after tax weighted average cost of capital of 10%. Please always remember that at 10%. Discount factor at 10%. So for year 1, obviously for year 0 it's 1. Then here that's equal sign 1 over 1.1. You get that much. Here that's equal sign 1 over 1.1 to the power 2. Get that much. Then equal sign 1 over 1.1 to the power 3. Get that much. Then come here and say 1 over 1.1 to the power 4. Get that one. Here, that's equal sign 1 over 1.1 to the power 5. Okay, we are done with our discount factors. Then we can then come to the present values, the PVs. Okay, just underline for it to look nicer. What's going on? Why is it refusing to underline? So for the PVs, you can as well underline. So the PVs equal sign, this amount multiplied by that amount, we get that, then we drag everything. Okay? And we must get our NPV. NPV is equal to, this should be equal to sum this much plus these other figures, and we get our positive 2847 point. So the NPV, remember, is in thousands of dollars. Okay, so ladies and gentlemen, this is our figure for the NPV. You pocket your 7 marks or 8 marks, and then there was that comment which should be made in terms of the variable cost. Okay, you need to make a comment, right? You can as well try to format your figures so that the decimal places, so that they become whole numbers, so you can reduce what's going on. I'm trying to, it's sticking. Okay, doesn't matter. Okay, I'm trying to format these figures so that they become, okay, yeah, something that's, they look a bit better now. The figures, they look nice. Okay, here you can as well try to reduce the decimals and make the figure a whole number. Okay, that's it, ladies and gentlemen, and I hope you have been but I don't like something I don't like here, something I don't like, because to keep on it's better to just format item by item. For example, the discount factors were now rounded up to 1, which might distort everything. Okay, at least this one should be to the nearest, that. Okay, so that's it. Anyway, this is the presentation, ladies and gentlemen, and I hope you have benefited from it. And as for the comments, we have seen that the variable costs were subject to some probability. Okay, they were subject to uncertainty. Okay, I mean, although there were some probabilities attached, we are not quite sure. Okay, we are not quite sure how under a weaker competition the variable cost can rise to say 1470. Okay, as you can see here. Let me look for a pen. All right, this $14.70, we do not know why it will arise, so there is need for clarity on the reasons, or we need to investigate what or how the variable cost per unit will rise to $14.70. Okay, but we are as well told that this is dependent on the quality of competition between the suppliers of certain components. All right, but we need to verify the authenticity of that information. Okay, we also have to consider the impact of this increase in terms of our net present value. Remember, it's an issue of sensitivity analysis. We are being taken to the issue of sensitivity analysis, so our argument should actually be in line toward that. In any case, I think I've done my part, and please replay the video. Don't forget to subscribe, to share, to comment, to like. Everything is actually welcome so that we do the right thing. Until next time, ladies and gentlemen, please continue to feel excited, very, very excited, because learning shouldn't be, learning accounting shouldn't be rocket science. Everybody should become a qualified accountant so that we stay, or we enjoy a world of informed business people, ethical individuals who shun corruption, who are determined to work for their countries, who are ready to fight for their lives, for their careers, and for their business future. Until next time, ladies and gentlemen, may the good Lord continue to bless you forever and ever. Amen.